Hello, and welcome to the Financial Literacy course presented by the Waco Alumni Chapter of Delta Sigma Theta Sorority Incorporated. Our objective for this financial literacy course is to arm and equip Waco and surrounding areas monthly with tools and tips to manage their finances confidently. Before we get started, please hit the subscribe button. Also, please like, comment on, and share this video as it will help us reach as many people as possible who would benefit from this information. Thank you. Episode 2: How Assets Create a Financial Foundation. In this episode, we will discuss the relationship among assets and net worth. The key takeaway: assets can lead to wealth and financial security. Net worth is a good measure of your financial stability. Calculate your net worth by subtracting your liabilities from your assets. Your liabilities is money you owe others. So, what is an asset? Something you own that has value. There's three types of assets: physical assets, financial assets, and productive assets. The value determined based on the type of asset. So many assets, especially financial assets, do not create a liability. So you don't have to borrow money to, say, build a savings account or set aside money for goals or create an emergency fund or even save an educational fund and or an able account for people with disabilities. Assets and liabilities are also related to equity. There are benefits of asset building. For instance, financial security, income and assets, foundation for your financial future, essential to achieving long term financial stability and growing wealth. Some examples of owning assets. So, what it does is it, it creates a buffer to handle emergencies, it helps you reach your goals, it increases your options and helps you earn more income, also inspires you to look to the future, and of course, reduces stress. To understand how assets create wealth, you need to understand how assets are related to liability and equity. An asset is something you own that has value. To get assets, you sometimes need to borrow money. For example, to buy a house or to go to college, most people borrow money. A liability is something you owe others, usually money. Once you borrow money, you have a liability until you pay it back in full. Assets and liabilities are also related to equity. Equity is the value of an asset minus the liability related to that asset. It's the part of the asset that you own outright. Now we will move on to net worth. Net worth is a measure of someone's financial wealth. It's your assets minus your liabilities. It is what you have left over after you pay all of your liabilities. Another way to think of your net worth is the equity from all of your assets added together. Your net worth can be a positive number, zero, or a negative number. A positive net worth means the value of your assets covers all your liabilities, and there is still some left over. This means that you have a cushion for financial emergencies. It's good to have a positive net worth. Zero net worth means your assets equal your liabilities. You do not have a financial cushion in this case. A negative net worth means your liabilities are greater than your assets. You do not have a financial cushion. So, calculating net worth. Step one, list assets and calculate total assets. Step two, list liabilities and calculate total liabilities. Step three, calculate total assets minus total liabilities. As a reminder, income alone is not enough to determine if someone has economic security. That income could be disrupted by the loss of a job or reduction in hours of work. Plus, you can't tell income income how much debt someone has. And you can't tell from income how much money someone has in savings or other assets. So let's look at a scenario with Justine. So Justine calculates her net worth. She bought her house 7 years ago. The current value of her home is $130,000, and she still owes $100,000 on her mortgage. She has $1,500 in a checking account and $500 in a savings account, which she uses for emergencies. Now, she has a truck that she bought used a few years ago. She could sell it for $2,000. She still owes $3,000 on the loan on the truck. She has one credit card with a balance of $1,000 and has a student loan balance of $15,000. She has a lot of furniture and heirlooms handed down from her grandmother, including some genuine antiques. Their value was recently estimated at $7,000. So, in figuring out Justine's net worth, we look at the information about her assets and liabilities that have been entered in the table for assets and liabilities. So, when you find the difference, we find out that she has left $22,000. So, after these calculations, we find out that she is not in a negative, she's in a positive. So, what does it look like to change your net worth? You can increase your net worth by increasing your assets or by decreasing your liabilities, or you can do both. So, I want you to consider what are some specific ways that people can increase their net worth. Some ways you can consider how you can increase your net worth would be spend less money than you make, buy less than you can afford, save money, use employer programs so they'll save money for you, use your debt responsibly, pay down some debts, explore public benefits, claim tax credits, shop around before you make any purchases, build more assets. So, for episode two, we want you to remember the key takeaway. Assets can lead to wealth and financial security. Net worth is a good measure of your financial stability. Calculate your net worth by subtracting your liabilities from your assets. This is the end of episode two. And as a reminder, please comment, like, subscribe, and share this video with friends and family on your social media networks. We thank you so much. Of course, for joining us, the Waco Alumni chapter of Delta Sigma Theta Sorority Incorporated, on our financial literacy course, where we aim to arm Waco and surrounding areas monthly with tools and tips to manage their finances confidently. This has been episode two, how assets create a financial foundation.